Thank you for joining us today. And my name is David Moore, and we are for Advanced 1031 Exchanges, the fun stuff. That's the presentation today. Got a lot of material to get through, and I think it's got a lot of little nuggets of knowledge for people. I think you get a few little ones out of it. It's going to help you get some deals done, whether you're a real estate professional, tax or legal person, or an investor. So it's all about helping you guys get deals done. And I just want to real quick, a little housekeeping. If you are in Oregon, you need real estate CE, please reach out to Seymour, C-M-O-O-R-E at 1031exchange.com, and she can get you some continuing education credit for this. And if you are not on our newsletters, also reach out to Seymour at 1031exchange.com. She can get you on that list. I'd like to say that 34 years ago, my brother and I put this company together, and we put it together with the idea we were investors that needed exchange work done, and we couldn't get it done at that point in time. And we just sort of looked at the marketplace. We were blessed to have a mentor that really came into, he taught us how to use the process through our own investments. And we really approach the business from an investment perspective. We're not going to just sit here and hold your money. We're about helping you get where you want to go. So if you call up, and I really encourage you, if you're working on a deal, even if you're working on a deal with somebody else, you're not getting answers, give us a call, because we like to say it's not about the deal, it's about the destination. We are always happy to put a deal together, even at the 11th hour. Though I really think you're selling yourself short on it. You need to understand that 1031 is not a tax or legal decision. It's purely an investment decision. You're doing it to get out of something you don't want and get into what you do want. And a lot of times we found that people just really don't understand exactly what's possible out there. So I like to present this class. I have a good time with it. I've got another one I'll have to do that is titled "You Can Do What You Don't Know." And it's even got some more edgy stuff in it than this class. But we're going to talk about the basics, basis and gain. We're going to talk about basics of the exchange, fallacies of the exchange process. We're going to talk about what I call the fun stuff, the complex transactions, reverse exchanges, improvement exchanges, partnership exchanges, related party transactions. And we're going to follow up at the end with some examples. If you see my class, a lot of these examples I use over and over again, I just think they really exhibit different topics well. Like I said before, it's not a tax or legal decision to do an exchange. It's purely an investment decision. And rarely is the question whether you can or can't do something. It's how we're going to get things done. And really the best approach is to reach out, ask the questions early, and really, the old saying about those who fail to plan to fail is true. I mean, you've got to look at it and understand, hey, I am here today. And as I said earlier, where do I want to be in 2, 5, or 10 years, and how am I going to get there? And there are people you say, well, gee, I'm going to have to pay the tax at some point anyway. And at least in today's world, a lot of times people are not in that situation. They can do what we say, swap till you drop. And at that point, what happens? You pass away, your heirs get a stepped up basis current market value, and that tax would go away effectively. There are other things. I do a class on end games talking about a variety of different things. Let's say you're tired of doing the exchanges. What else is out there for you at the end of the day? Or maybe you're tired of, you're a rent control refugee and you're just tired of dealing with those properties. Maybe you've got a spouse that says, hey, I'm tired of fixing the properties. Let's go play. Let's go travel. And I don't want to take the call at midnight, or it seems like Christmas Eve when the pipes always break. So there's a variety of end games out there for you. And like I said, a lot of times it's a situation where you just don't know what you don't know. And as we get older, I always like to say that I'm really sort of tired of being taught things. I'm always happy to learn, tired of being taught. So if we can help you get through some things, help you plan to get where you want to go, we're all about that. And I invite you to reach out with questions or concerns. As I said, even if you're working with somebody else, we're happy to help you out. So Advanced 1031s, the fun stuff. We work with taxed money via 1031. We also have a sister company, IRA Advantage, that works with retirement funds. And yesterday I was scheduled to speak on the IRA 401k biz. And you think about Wall Street the last, well, we could say the last month, but the last few days has really been crazy. And in real estate's one of those things where if we look at real estate in the investment world, real estate's considered an alternative investment, which drives me crazy. I mean, I name an older investment that's out there. I mean, maybe it's precious metals, but real estate's been there for as long as anyone can remember. And it's, the thing is, it's not considered a liquid investment. And since it's not considered a liquid investment, typically we have the whoop-de-doos, the roller coaster is a much slower thing. When they go up, it's a slower change. Going down, slower change. And what drives me crazy about Wall Street is the golden rule is never buy or sell on news, and that's all people do today with the internet. It's just unbelievable. If you look at yesterday, if you watch what was going on, and for future context, it is, today is the 7th of April in 2025. So when you're watching this in the future, you can take a look back and say, okay, well, what was happening in Wall Street during that week? And it's been pretty entertaining. And it's just, I mean, minute to minute, things are going back and forth. Where real estate, we've got much slower movement on that stuff. And I was talking to a buddy that actually is in the custom boat world this morning, and they have boats built overseas, and we're looking at that tariff, just talking about tariffs and what's happening. They've got a big boat, a 57-footer coming in. It's on a freighter right now, and he doesn't know what the repercussions of tariffs, what it's going to cost them for that boat to get off the ship and get it in the United States. And obviously it's something. If we look at today's news and what's being threatened versus maybe tomorrow or later today, it's going to be different. But if we look at real estate, I don't think there's a better investment. I mean, I've got a good buddy that had a good buddy, unfortunately passed away a while ago. You've probably heard me talk about him in the past. But he was the 1031 guru, and he just said real estate's not a get rich quick scheme. It's a get rich surely but slowly scheme with one golden rule: don't get yourself in a situation where you have to sell in a recession. So even if you've got let's say if it's unencumbered property, it's not going to go away unless you just cease to pay any property taxes. Even in that situation, it's going to take a while. For the people that unfortunately suffered through the last recession, you might have had situations where properties were not being paid and paid for, and those mortgage payments go delinquent. And even in that situation, it takes a long time, and you're still given a period where you can fix that problem. We're going to talk about something called phantom gain, and that's a situation where you've got debt over basis, and in a short sale or foreclosure, people would still have tax exposure in that situation. So it's really important. I'm going to say that we're just one person on that team of professionals for you. And I'm going to say great brokers, obviously important, good finance people, property managers, good title escrow people, and good tax and legal people you're paying to put an opinion on something, not paying to learn on your behalf. It's a complicated world out there, and build that team. And that's the best formula for success you can have. Get those people in your corner working for you. So what's gain? I mean, what do we talk? Why do we even worry about a tax deferred exchange? And I'll just say, one of those things that every time the new politician gets elected, it seems like we have to fight for 1031 survival, which is, it's over 100 years old at this point. But I sometimes jokingly say it's an IRA 401k for real estate, and that's coming from a guy that works with IRAs and 401k plans, right? So when Wall Street complains, well, gee, we don't have 1031. Well, yeah, you've got tens of trillions of dollars. It's all qualified money, IRA 401k funds that's got automatic tax deferral. If we look at real estate compared to the Wall Street stuff, the thing that's really a big difference between the two is Wall Street's got a big advantage in that you're not having to pay tax on those stocks the entire time you own them. Where real estate, you've got property taxes you're paying the entire time you own that asset, and that's something that Wall Street doesn't contemplate. But 1031 is just a tool, like I said, to defer gain. It's a tool you would employ to get yourself out of something you don't want and into something you do want, keeping that equity intact. And if you look at what that cost is, it can be pretty dramatic depending on whether it's a short-term normal income tax consequence or long-term capital gains tax consequence. And the reason I mention both is that a lot of times people will talk about holding periods in 1031 and how long something's got to be held to qualify. And really that's, once again, it's going to come back to you and your tax people, because there's not a black and white required hold there. But so what I'm saying is that the hold period is not there to dictate it's got to be a year or more, let's say, for long-term rate held on something held for investment, or less than a year. There's nothing stating it's got to be held a year or 5 years or 10 years to qualify for 1031. The difference is if it's something that you acquired with the intent to hold for investment, you held it for under a year, and you went to sell it, you're going to pay normal income tax, short-term capital gains tax rate. If it's held for investment in excess of a year, then you're looking at a long-term capital gains tax rate. Either way, the property is potentially 1031 worthy. So it's not a situation where it's got to be held a year to qualify for 1031. We're going to talk about holding periods in a bit, so I'm not going to go any further on that. But you need to understand that the tax rates are going to be dictated by what you've done with the property and how long you've owned that thing. And gain has absolutely nothing to do with property, or with profit. I'm sorry, not property. Hopefully gain has something to do with all your property. Hopefully you're making money on this stuff, but it has nothing to do with profit. It also has nothing to do with net proceeds either. I mean, whether you receive a single penny on a disposition, that really has no bearing on whether you have a gain that's been triggered on that disposition. So gain is just simply the adjusted sales price minus the basis on the property. Your basis on the property is what you paid for it, plus capital improvements that were made during the time you owned it, minus depreciation. Now, I sit on the phone with people all day, every day, talking about these things. And when I'm talking to somebody, say, okay, when you bought the property, how did you buy it? Or was it gifted to you? Did you inherit it? Did you, at some point, maybe it was your home and you sold the home and you bought a new home? If we go back prior to 1997, we had our old 1034 residential, rollover. So you had 2 years to buy a new home of equal or greater value to what you had relinquished. And if you did that, then you were going to be tax deferred on it. 1033, involuntary conversion. The government comes in, takes a property from you. That's a 1033. You don't need me for that. And you've got a different set of timelines to work within, but it's a basis carry forward. 1031 is a basis carry forward. So that purchase price, quote unquote purchase price, varies dramatically based upon how you got that property. If I gave you a property, your basis is what mine was. If I passed away, you inherited it, you got this stepped up basis. So on top of that purchase price, we've got the capital improvements. Every dollar you put into something, you either expense or capitalize it. If you expense it, you wrote it off. You capitalize it, increases the basis. Then we've got depreciation. Depreciation is not an elective thing. If you've got a property that is supposed to be depreciated, you're going to be taxed on depreciation recapture whether you took the depreciation or not. So once again, great tax people are critical because they're going to make sure things fit. And I guess a real quick comment on depreciation. I've got a good buddy, Jonathan, that works in cost seg, and I'll probably have him do a class with us soon. I think it's a good topic to have everyone more aware of. If you want to know more about that, you can take a look at our YouTube channel. Just type in on YouTube Equity Advantage and then cost seg. You're going to see a couple of videos with him talking about cost segregation. But cost seg, in the most basic sense, if we look at a depreciation, you buy a rental house and let's say you buy it for $500,000. Are the improvements worth $200,000, $400,000? If it's worth $200,000, how does that impact your ROI versus having the improvements worth $400,000? Well, a rental house, you've got a 27.5-year depreciation schedule. So you're either taking 200 over 27.5 or 400 over 27.5. So you can tell that by jacking up the value of the improvements, you got more depreciation, your ROI is going to be increased. So who makes that initial allocation between the dirt and improvements, and how does that impact your ROI? It impacts them dramatically. So that's cost seg in the most basic sense. Well, if you employ somebody like Jonathan to go do a cost seg study for you. He's going to take your building and break it into 200 different components, accelerating that depreciation over a much shorter period of time, increasing your ROI. So, those things make a big difference. But I just want to warn people that if you got a rental house and you never took depreciation on it, if you got audited, they're potentially going to tax you on depreciation recapture that you never got the benefit of. So once again, take advantage of the people in your life, use those resources. Don't talk to your tax people for the first time April 14th. You want to talk to them before you ever sell anything, understand what your gain is on a disposition, and at that point you can decide whether you want to pay it. The exchange is not always the right thing to do. I mean, if you're going to buy something that you don't want just because of it, don't do it. I mean, then you're just looking at a question of when you should pay the tax, and having tax exposure is one thing, taxes owed is something totally different. So if we look at that gain, once again, we're looking at the adjusted sales price minus the basis. The basis is what you paid for it plus capital improvements minus depreciation. And if you look at those things, you're going to come up with a number, and then you talk to your tax bill, hey, this is what the cost is, and then you can just decide whether you want to do an exchange or not. Now, something I want to caution you over, and fortunately we haven't seen this happen yet. I keep sort of waiting for it, and I sort of, unless changes occur in the finance world, we're in a market where we've got, let's say, a lot of people that went out of residential type properties, 4 units or less, and you might have 10, 20, 30, 40-year money on those loans. And those people may be, if you start getting investment in real estate, let's say in 2012, you've never seen a bad day. Things just kept going up. Well, now you might have a large commercial building or even a bigger multifamily unit. And now you've got a situation where you've got 7-year money that's coming up for renewal, and maybe you bought it, it's at 3.8%, and now you're looking at 7 or 8% on that same loan. And worse yet, maybe the building didn't go up in value, or maybe they're wanting you to put some additional equity into it because the loan to value is too great. So there are a lot of people that are going to be facing a situation where they either have to sell or do a refi. And if they're not prepared to do these things and looking forward far enough, once again, plan ahead. Look at where you're vulnerable and don't wait until now you got to replace it. Start working on that stuff. But what happened in the last recession is we had people losing property to foreclosure or doing short sales. And what happens in those situations is the debt on the property is treated as the sales price. So if you've got, let's say short sale, you've got a sales price below the debt. Okay, it doesn't matter. That debt is going to be treated as a sales price for tax purposes, not the actual short sale price. So there are people that have transactions where they had lost properties foreclosure or short sale, and they actually had what's called phantom gain. And that phantom gain is the gain that's realized when you look at that debt over basis, and the debt's treated as a sales price. So if you lost a home in that context, you had some tax relief, but income properties you don't. So it's really a situation where we were actually doing transactions. People say, well, gee, how do I have any tax consequence? I didn't get any money out of it. I lost all my money. Well, it's irrelevant. Gain is simply a tax calculation, period. It has nothing to do, like I said, with net equity or you actually making any money on that investment. It's just a tax calculation. So what would happen is we would actually have the property transferred to us pre-foreclosure. When the property was foreclosed, it was ours, not the taxpayers. That transfer date is what started the 45 and 180-day timelines for the exchange. And for these people, it was a pretty easy question answer, I'm sorry, because when you start looking at the tax consequences of these situations, what are we looking at tax-wise for a long-term capital gain? So short-term, once again, is normal income tax. Long-term, you're looking at Fed rates typically of 20% on appreciation, 25% on depreciation recapture. States can be anything from 0 if you're in Texas up to 13+% in California. Oregon could be 9 to almost 12%. So you're looking at Fed at 20 to 25 plus whatever the state tax on top plus the 3.8. So you can very easily exceed 40% tax rate, and that's assuming a long-term capital gain, not normal income tax, where it could be in excess of 50%. So when people start talking about, well, the wealthy need to pay their fair share, what's their fair share? And you think about, okay, you bought this stuff with tax money. You're paying for everything during the time you own it with tax money. If it's real estate, you're paying tax on it during the time you own it. Now you're going to pay tax again when you sell it. And then maybe when you pass away, depending on where you are, and believe it or not, I'm talking to you from Portland, Oregon today. If you're a high net worth person, you're better off passing away in California than you are in Oregon, because Oregon doesn't follow the federal guidelines on estate taxes. So how many times do you want to pay tax on that same money? And that's where we look at 1031 and in keeping your money yours going forward. Okay, the IRA or 401k in Wall Street keeps you moving forward. You don't have to pay tax on every disposition. A traditional IRA is tax deferred money, that's going to be taxed when you take distribution. A Roth IRA is tax money that grows tax free. 1031 is a situation where we're just keeping your money yours, and you've got a choice every time you sell the property. Do you want to pay the tax, or do you want to defer it via 1031? And those decisions need to be made prior to close. If you close on anything, it's too late. So just make sure you're taking advantage. Once again, you contemplate a sale, first call you're going to do is you're going to talk to your tax people and find out what the tax consequence of that disposition is. And maybe you've got something else that's going on in life that can mitigate the tax consequence. And if you can do it by offsetting the gains with losses or something else, then I'm going to tell you not to do the exchange, because the exchange is not patient money. The exchange, the opportunity cost of the exchange is that you've got to find something within 45 days of settlement. You've got to close within 180 days. Okay, or the due date of the tax return. So late year transactions, you need to make sure you're filing extensions. Don't file a return prior to you completing the transaction. But that's not patient money. And the other thing is that you've got value and equity requirements that 1031 has. So if you've got the ability to just sell and with no tax consequence, and now you've got money, you've got the gold, the old saying, with those with gold make the rules, you have that money with no strings attached to go deploy at will at whatever time you want. There's benefits there. The other thing is, once in a while, we'll have somebody, let's say, buy a property. They want to do an exchange out of a pure investment. They want to go buy a place to retire into. And, the opportunity cost that transaction is that you've got to, when you complete the acquisition into that property, it's got to be held and seasoned as an investment property for a period of time. Let's say that's a year. I'm going to say, look, what's your tax consequence if you don't do the exchange? If your tax consequence is, let's say, 40 grand, and you're looking at living someplace else for the next year, if that's $3,000 a month, what's that? 36,000. So is it worth $4,000 to you to do an exchange and sit on your hands, put your life on hold for a whole year, or should you just pay the tax and move into the thing that you want? So, once again, rationalizing the transaction. 1031 is not always the right thing to do. Understand the tax consequence and where you want to go. And then, if we're going to be talking about reverse exchanges and improvement exchanges. So a delayed exchange, let's say if it's under $1 million with us, you're looking at a very inexpensive transaction. Maybe it's $2,000 to do the entire exchange. That's not very much. It's probably the smallest number on your settlement statement. If you're looking at reverse exchanges, those things might start off at a base setup of $6,500, improvements depending on what we're doing, $7,500, $8,500 or more, just for the basic setups, and a percentage of the value of the project involved. So a delayed exchange is virtually nothing. Even reverse and improvement exchanges aren't that much, but still there's a cost to them. And you just sort of have to look at the total cost of what's happening. If we're doing a reverse exchange on top of the cost, our costs, you're going to have potentially some financial costs that might be impacting you too. So it's really important to understand, what's the whole thing going to cost you, and the opportunity cost is that you've got this timeline that needs to be met, and it's just, keep those things in mind. Ask for the time you need to get where you want to go. So this chart just shows you different states, different tax rates. The gray states are the zero tax rate states, and obviously those are popular just from the tax consequence perspective. And also, those states are typically going to have more ownership rights. So you rent control refugees, you're probably going to want to stay away from the highest tax rate states because you have no ownership rights, and the lowest probably state tax rates are going to give you the most ownership rights in my experience after 30 plus years doing this stuff. So anyway, I just think this map's interesting. The striped means that we've got a couple of states there that are going to have capital gains. For example, Washington, capital gains, at least at this point, does not apply to real property where it does to stocks, bonds, stuff like that. So that's why those striped states are up there. There's a few examples of things that people say that they're just wrong. Okay, exchange fallacies, and it's sort of interesting to me. All these years go by. Like I said, 1031 is over 100 years old at this point. The really sort of the last structural guidelines, we had reverses that we got guidelines in 2000. But if we look at really the formalization of the code was in 91 with most of the major rules. So when we look at like kind, a lot of times people used to come out and say, well, I remember when it meant house for house, land for land. It's never meant that. It refers to the nature of the investment rather than the form. So any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. The next one is section 1031. It says does not require 2-year hold. If you look at our YouTube channel, for example, one of the highest viewed videos is the fallacy of a 5-year hold. And we kept getting asked this question, well, the code says 5 years. A lot of times people say, well, the code says 2 years. Well, it says 2 years in a related party transaction. So, who's a related party to you? A related party would be your lineal ascendants, descendants, their spouses, or any legal entity owned and controlling interest by one of those. If you swap with a related party, both parties have to be doing exchanges, and both parties have to hold their respective replacement properties for no less than 2 years. We're going to talk a little bit more about related parties a little later, but in a nutshell, that's sort of what it says. Now, there is some fine print that would say, well, gee, the 2-year doesn't apply if there was no intent to avoid tax. Is 1031 avoidance deferral? I'd say it's deferral, but once again, you want to have that conversation with your tax people. All right. So the 5-year hold has to do with a situation where you exchange into a property and you hold it for investment, let's say for a period of time, then you moved into it. If you were to then sell it within 5 years of acquisition, it'd be a fully taxable sale. After 5 years, you're going to be subject to something called the Housing Assistance Tax Act of 2008. So for those of you out there that think, hey, I'm going to just do this exchange into the property that I want to move into, I'm going to hold it a year, move into it, hold it for 2 years, satisfying section 121, the universal exclusion, and I can sell and get rid of your gain. That does not work. It worked for a couple of years in the late 90s. It does not work. And as I said, if you sold it within 5 years acquisition, it's going to be fully taxable. And even after the 5 years, you've got that Housing Assistance Tax Act to deal with. 3, there's no limit to the number of properties relinquished and received in an exchange. A lot of times people say, well, I can ID up to 3 properties. The ID rules, there's 3 different identification rules. Each rule works independently of the others. The first one just says up to 3 properties of any value. Second one says you can ID more than 3. Total value can't exceed 200% of the relinquished property's value. Third rule says you can ID more than 3. The value can exceed 200% of that relinquished property's value, but you got to close 95% of the aggregate value of all properties identified. Now, let me ask you this. What is a property worth? How do you come up with the true number? Is it what it's listed for? Or is it worth what you're going to pay for it? I'd say it's worth what you're going to pay for it. So when we're looking at the second and third rule, the 200% rule, the 95% rule, you need to put down a number there. You're going to give the identification of that property, which typically could be a common address, including city, state, and zip. If you're buying a piece of something, it needs to be that portion that you're going to buy. But you'd also put in a value if you're going to be IDing more than 3 properties. Yeah, and back to my comment earlier, is it worth what it was listed for? Well, does a property have to be listed to be identified? And that's why I laugh, because when Tom and I put the company together back in '91, we had an audit manual, and one of the questions in the audit manual was the property listed at the time of acquisition or time of identification. Totally irrelevant. It doesn't have to be listed to be ID'd. It doesn't have to be on the market to be ID'd. If you're going to do a for sale by owner, you're buying directly from your neighbor, whatever it is, it doesn't really matter. You're just giving that property as the ID property that you intend to buy. And there's nothing that would require it be on the market. Define being on the market, right? So there's lots of transactions where people, that old movie, I don't know if you guys remember Heaven Can Wait, but the guy owned the Rams and ended up selling the Rams, and one of the coaches like, well, how'd he do it to you? How'd he force you into this sale? Well, I asked this, and he said yes. Bastard. Anyway, so everyone's got a price, and so what happens sometimes once in a while, and we look at holding periods too. You might buy a property and you get such a great deal on it, and maybe it's a rental house, for example, and one of the neighbors says, gee, I wanted that thing. How did you get that thing? Well, I'll pay you X. Well, could you take an unsolicited offer from somebody that the offer was too good to pass up? Could you do that? And the answer is yes. Once again, I want you to talk to your tax people about it, understand that, but your intent was clearly to hold things. Now, if you're somebody that flips property and you're maybe you're a real estate broker, or you're a contractor, now you've got something called the Clarkowski court case, 9 points used to determine dealer status. It's going to greatly complicate that transaction. But if you just happen to buy a property that was a great investment for you, got an offer that was too good to pass up, could you take that offer? And I would say yes. Another situation where we had much abbreviated holding periods was during COVID. We had people buying properties. Suddenly governors would say, well, gee, the tenants don't have to pay, and nobody's telling the banks to sit tight. So these people would have to sell the property because they couldn't afford to keep the thing. So it has to do with intent. And if you're flipping property, once again, that's a business. So not only does it not qualify for 1031, but you're also you're stuck with normal income tax on those transactions if you're working with tax people that really understand what's happening there. But when we're looking at number of properties relinquished and received in an exchange, any number is possible. 4, this is something that's coming up a lot right now. And once again, I'm just going to reference back to our YouTube channel. If you want more details on seller finance, we do have a page talking about it. But this topic is huge because financing can be tight. So people are looking for seller carries. And the issue is, if you're buying and you want the seller to carry, great. I mean, it's wonderful vehicle. If you're selling and it's an end game for you, that's fine too. But you better understand that when you sell and carry a note, that you're going to have some major tax consequences if you're not careful. And what I mean by that is you're going to have tax on debt relief and depreciation recapture in the year of sale, whether you received a single principal payment or not. You better get enough of a down payment to cover all the closing costs and any potential tax obligation you're going to be incurring. I would also say, if it's you're the seller, you're carrying paper, whose paper is it? It's yours. So you better make sure there's an acceleration provision in there, and you better have some guidance on assumptions too. You don't want to just have blind assumptions on there where the person that buys a property just decides he or she doesn't want it, and somebody else can just take over that loan because you don't know anything about them. So it's your paper. Make sure it takes care of your best interests. And we're going to talk a little bit more about that in the future. But if you want to do an exchange, you want to carry paper, that paper has to become ours at close. So anything that you receive that's not of like kind in a closing is taxable as quote unquote boot received, and you're going to have an issue. You cannot receive the note and then do something later. As soon as you receive that note, the tax consequence is baked in. It's just a question when you're going to have to pay that tax, but there's no way to deal with it. If you want to do an exchange, you're carrying paper that, just like the cash is ours at close, the note's going to become ours at close. And we've got a variety of things we can do with it, which we're going to get to in a little while. 5, this is another topic that's huge in today's market. You have to replace debt in exchange. You do not have to do that, all right? Debt can go away 2 ways. One, by going down in value. This triggers tax because you went down in value. The other way debt goes away is by adding cash, which is always going to be fine, all right? So I'm going to say it again. You don't have to replace debt. If you gave up a property that's, let's say, a $500,000 property, and you wanted to go buy a $700,000 replacement, and maybe the relinquished had a couple $100,000 in debt on it. You want to go buy the 7 outright, that's fine. You're putting money into it. So what we say is you can offset mortgage boot or reduction in mortgage with cash. You cannot offset cash boot, cash received, with additional mortgage. Finally, 6, 1031 is not an all or nothing affair. So as I said earlier, we're sort of talking about understanding the tax consequence and then how to mitigate it, maybe offsetting gains with losses. Maybe you only want to do a partial exchange. Maybe you've got some losses to offset a piece of it. That's fine. Or maybe you're fine saying, hey, I want to pull 20,000 out, go take a trip. Well, you just pay tax on the 20, defer the balance of it. We've got an example, a slide where a guy went from a $3 million relinquished property into $1 million replacement property. At the end, we're going to talk about that. And that was what they wanted. Okay, they didn't care about the fact they had some tax exposure on one piece of it. They were still deferring enough gain that it made sense for them. And that's why they did a partial exchange. So it's not all or nothing. And once again, your work with your tax and your financial, I'd say, talk to your finance, or your not finance, I'm sorry, your tax people, understand the tax liability, the obligation you might have there. And also, you're going to be working with your financial advisors before year end. Take advantage of them, right? You say, okay, gee, I sold this property. I've got this gain of this in it. Do I have any stocks that I can sell and realize losses on to mitigate that tax exposure? So use your financial professionals, whether they're the finance people, whether they're the tax people, or whether they're your Wall Street investment people. Take advantage of those people in your life and don't just do it reactively, do it proactively. Conversion of property. This is one of those things that happens all the time, and I would say that if you're looking at, for example, if I go into a commercial brokerage and I start talking about Section 121, they're going to say, well, gee, we don't care about 121. That's for a primary residence. We don't sell houses. Well, don't you think that the people that have large investment properties probably have large homes? And you think about the gains, you think about Section 121, the fact that it got put in place in 1997, it only gives $250 personally or $500,000 for a married couple. That is woefully inadequate in today's world. So we have situations where we have, a lot of times if I walk in a commercial brokerage, start talking 121, they're thinking, well, it doesn't apply to me. Well, hey, if they're doing something that helps their investors, they're probably going to be grateful. They're going to, that little nugget of knowledge. If I walk into some pure residential real estate broker and start talking 1031, they're going, well, gee, I only work with owner occupied stuff. Why would I care about it? Well, once again, the gains in excess of 250 or 500, do they have to pay that? Or is there a way around it? So we have many times where we have people converting properties from investment to residence. So let's say we complete an exchange into a property that they ultimately want to retire into. That's a 1031 into a ultimate retirement home, and there's going to be timelines they need to season it. Or we're in a situation where maybe they're selling their home and they've got gains well in excess of 250 or 500, and they don't want to pay that. So we're going to tell them to move out of the house. And I'll just say it right now. You can hear me say it again when we talk about that example later. The property does not have to be rented out. It's just got to be held for investment. All right. So there's reasons to convert an investment to residence and residence into investment. Both can be done. And it's just a question of timing and how long something needs to be held. And really that is totally subjective, and it's a decision you're going to make between you and your tax people. So I always like to say, what's a property appear to be and what do you really want it to be? And by the way, there are examples of a single asset with allocations 121 and 1031. Let's say a house on acreage. You got the house and maybe an acre or two around it, and then you've got all the working land that's going to go. So that portion, the homestead portion is 121, the working land's 1031, a duplex, half owner occupied, one sale allocations, different directions. How about your home? If you're working out of your home these days, maybe from COVID, you started working out of your home, your tax people say, okay, you've got a home office, you're going to treat it as a home office. You go to sell that home. If you've been treating that home office as such for more than, let's say 3 out of the last 5, now you got a situation where that piece of your home has to be exchanged or you're going to have tax exposure on that piece. So it's really important to understand, yes, you can convert one thing to another, either direction, or you can have a single asset with allocations different directions. All those things, once again, you don't know what you don't know, and that's where good tax people are going to come into that picture for you. So when we talk about converting assets, how long is long enough? Well, this resync case, and I said earlier, that 5-year hold or the 2-year hold with a related party. So the 5-year, once again, was an acquisition and seasoning before a sale. Or if you acquired it, converted a primary residence, sold it inside 5 years, it's fully taxable. If you've got a situation where you've got a transaction, I got something that screwed up my screen. Hold on a second. Get back to what I want here. Okay, hopefully you got that again. All right. So if we've got that situation where it's going to be, sorry about that, somebody bothered me, seasoning, and if we got this resync case, it was a situation where it was only a 4-month hold. People bought a property and tried to rent it out, and they couldn't rent it out. They documented the showings, the listings, and when they ultimately did what they did, they got audited and they got taken to court, and they prevailed in court even after a 4-month hold in this situation. I don't want to see anybody be in a court case. Typically, I'm going to tell people 1 year is what I'm going to want to see in these transactions. So, and 1 year I look at from two different contexts. One, that's the break between short and long-term tax rates on assets held for investment, which obviously, who are we to argue with the IRS on something? And two, 1 year's been proposed a couple of times. So I think 1 year is a good safe timeline. If it's less than that, it really has to do with what's going on and what you do for a living, so on and so forth, how often you're doing these transactions. But that seasoning and how long is long enough is really this slide. I've got long enough with an E on the end, the second one. I don't know what, I got to fix that. So first time I've used this presentation. Anyway, it's discretionary. It's up to you and your tax people. And like I said, I gave that example earlier of a situation where somebody bought a property and they got that unsolicited offer that was too good to pass up. And for them to get lucky once, it's not a problem. For them to get lucky over and over again, obviously you're establishing a pattern and you're going to have a problem there. So real quick, basics of the exchange, then we're going to hit the fun stuff and a few examples and be out of here. So cornerstones, I like simple. 4 basic things have to happen. One, it's got to be an exchange. You're selling something, buying something, we're going to turn it into an exchange. A reverse means we're going to buy something first and sell later. I just want to caution you, we're going to talk about reverses, but you cannot close on that property without it being structured as an exchange. So you cannot legally own the new property and an old property simultaneously. There's got to be some period of, it's got to be structured as a transaction. If we're talking about improvement exchanges, reverse exchanges, those are something called warehouse transactions or parking transactions. And that means that we're going to own those properties for a period of time to accommodate the transaction. So something's given away, something's given back. 2, what's relinquished and received have to be of like kind. Like kinds, the nature of the investment rather than the form. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. 3, for total deferral, and once again, I'm going to say it's not all or nothing, but for total deferral, you need to go across or up in value and equity. And I did not say anything about debt. Remember that. Debt could go away by going down in value, triggers taxes went down in value, or debt goes away by adding cash, which is fine. And then finally, we've got to have continuity of vesting. Just means the taxpayer that relinquishes a property has to receive. The biggest headache with any exchange is always going to be the timelines of 45-180. The second biggest issue we have to deal with is that vesting issue. All right. This is a topic, when can you get your money out of a transaction? Okay, when you get let's say you've got an exchange set up and you don't want to complete it, or maybe things didn't work out, you couldn't find what you wanted. It's really critical that by that 45th day, so when you set up the exchange, if the relinquished property closes and the money gets to us, you're stuck with us till day 46. All right. So let's say a week in, 2 weeks, and you said, David, I don't want to do the exchange anymore. I said, okay, fine. We can give you your money on day 46. And you say, well, what do you mean by that? Well, there's something called 1031 G6 that states, and this is not a company policy. So there's something called an accommodating accommodator. And if somebody's just going to give your money at will, not only is it, you might say, well, gee, I don't care, I'm going to pay the tax anyway. The problem is that the policies, procedures of that company are not valid. Therefore, any exchange that company does are invalid. So any company that's just going to give you money outside of 1031G6, I would not be working with them, period. Anybody that does this for a living, they're going to work with 1031G6, which basically says you can only get funds out after you've purchased everything you have the right to buy, which means that inside the 45 days, you can identify anything. Therefore, you can buy anything inside that 45-day timeline. That's why you can't, no matter what you're doing, you can't just take money out of the deal until day 46. So if you want to pull money out of a transaction, you can either do it at close and it's excluded from your exchange, or you can do it after you purchased everything you have the right to buy. So if we get to the 45th day, or let's say we're approaching it, you haven't found anything. Even if you ID'd something, I'd say if you don't want to complete it, you're going to rescind the identification before midnight the 45th day. You cannot rescind the identification after that 45th day. So keep in mind, if you got things ID'd on day 45, now you have to basically buy those properties, or you're going to have to wait till day 181 to get those funds. All right. So if you get to the 45th day and you haven't found it, rescind the ID. That way on day 46, we can get you the money. Now, depending on your identification rules, let's say you're working with the three property ID rule. If you're IDing 3 to buy 3, then that's great. If you're IDing 3 to buy 1, in our ID pack, what we've done is we've got a paragraph in under where you're listing the properties. It says, I'm identifying these properties with the right to buy blank. So if you're IDing 3 with the right to buy 1, you put 1 in there. That way, as soon as you bought the 1, if you had excess funds in there and we're outside the 45 days, then we can give you the balance of money. If you didn't lock it down to 1, you ID'd 3, even though you bought the one you wanted, any residual proceeds would have to stay with us until day 181. So why this is really, really important is, imagine you didn't find what you want inside the 45 days and you ID'd something just in case, and then on day 60, you find what you really want. Well, we can't get the money out of the transaction for you. So it's really critical on the 45th day that you're either totally committed to completing the transaction, or you should torpedo it, terminate it at that point in time, and that way you've got the money to work with going forward. But 1031G6 is something that's very, very important for you to understand. And once again, to summarize, when that money comes to us, we can only send funds out. We can send money out, obviously, for any purchase that's been identified, but we can only get money out to you outside of that after you've purchased everything you have the right to buy. So it's really critical that in a market like we're in, that you understand that, and on that 45th day, you're either totally committed to completing the exchange, or you should terminate it. Current trends and issues. A lot of times people would just look at extending timelines. We've got the ID dates for the exchange. We're rapidly approaching tax day, and if you're in an exchange, I'm going to tell you, file an extension so that you're not torpedoing your exchange at that, artificially, right? This has only happened, I think, one time that I'm aware of in 34 years, but somebody filed a return. There were two partners in a transaction. The one that understood all the 1031 rules was doing one thing, and the other party that didn't just filed the return for the partnership and sunk the transaction. So just make sure that you're completing the exchange before you file the return. If you're bumping up against the 15th of April, then file an extension so you can complete the transaction before getting your final tax work done. 2, 1031G6, like I said, we're in a situation where you make sure that you're in that transaction, understand when you can get the money, and make sure you don't get yourself in a situation where the money's stuck with us when you want it out to do something. Partial exchange is another transaction that we're doing a lot of these days, because maybe people have losses elsewhere to offset some gains, or maybe they want to pull some money out, do some other things with it. All those things are possible. Think of it from the context, every dollar you spend over your basis represents tax deferred gain. A lot of people are just buying a 45-day ID period. They don't know where they're going to go with it, but they know they want to buy 45 days to see if they can find something to fit their exchange requirements. We've got a number of people that are just getting the 45th day and saying, the heck with it. I tried, and I'm going to, give me my money on day 46. They sent us to wiring instructions, get the funds out to them. Moving on up or down, people expanding into bigger properties or just once again downsizing because it's not all or nothing. A lot of times people are buying into multiple assets too. We've got DSTs and tenancy institutional TICs that are out there, Delaware statutory trusts. And institutional tenancy and common properties. Those things are popular as rent control continues to bash the traditional mom and pop owners. They just can't deal with the stuff anymore, and they decide they'd rather go travel and have somebody else deal with those headaches. So that's where those two things come up. DSTs and TICs, obviously, that's a whole nother conversation, what they are and how they work, and we'll probably have something that is going to talk more about those. And then we've got a number of transactions where people want to combine personal money and plan money too. So combining 1031s with IRA and 401k funds, that's definitely possible depending on how we're making the initial acquisition. It might drive the deal into TIC, or it might drive the deal into common membership of an LLC. Each structure has its ups and downs. Partnership transactions. So partnership issues, that's that vesting piece. So the 45 and 180 is always going to be the biggest issue, but vesting is the second biggest deal. So we've got the transactions where partnership interests are specifically prohibited from 1031 treatment. So we're always looking at how to make these things happen. And really we're looking at if the partnership wants to go forward, that's great. But if members want to go different directions, since we can't exchange a membership interest, a partnership interest, we have to somehow structure a transaction that will work. And the typical path is something called a drop and swap. And that just simply means that the ownership will drop from the limited liability company to a tenancy in common, ideally before the property is ever put on the market. The problem is people don't think about it when they're putting on the market. And even if they do, it's sort of a cumbersome situation, because if you've got a loan on the property, if it's between the lender and the partnership, and you change the vesting, there might be an acceleration provision in there. If you've got a bunch of tenants, you're probably going to have lease agreements. You've got a variety of things that need to be done to shut down that legal partnership. And so it needs to be broken, ideally in a time period that allows, after the break, the property to be seized and is held for investment by the individuals. Now, if we're talking, let's say we got 5 members in an LLC and 2 just want to go away, the other 3 want to go forward, great, we'll keep the 3 that want to go forward in the entity and take the other 2 out, and then they can pay their tax or they could do an exchange depending on the seasoning periods between that drop and the actual swap. So the drop and swap means we're breaking the entity pre-sale. And 9 times out of 10, unfortunately, that change happens while the deal's in escrow. And it just, once again, it happens for a variety of reasons, but often it's just not thought of until then. So the vulnerability is, did you personally hold the property for investment predisposition? There are states that would much rather see, instead of a simple assignment from the entity to the tenancy in common, they'd like to see a new purchase sale agreement, so you're not putting their nose in it. All right. The swap and drop, it means just we're going to do an exchange for the entity into, let's say, if there were 5 members of that entity and they wanted 5 different properties, we'd do the exchange into the 5 different properties. Typically, we'd buy each property in a different limited liability company, hold those things as such, let's say for a year or so, and then after that year's time, we do assignment of membership interest from the exchanging entity to each of the individuals for their respective properties. So the downside of that transaction is you're still all married to each other for, let's say, another year after acquisition. Sometimes that's okay, sometimes it's not. The other issue is if there's financing on the properties, and that sort of encumbers everybody too, so that can be sort of problematic also. 9 times out of 10, the drop and swap is the way it's done. We do the swap and drops, but just not that often. But really, it just comes down to how you're owning things, and this issue can be a problem even for spouses. Let's say in Oregon, we're not a community property state, so even spouses are considered legal partnership in an LLC. So we really, and what's dangerous is you've got a situation where maybe you got rental houses and maybe you go up into plexes, and anything 4 units or less is residential loan. So you give up a property in an LLC as spouses, you go buy the new 4 unit or less, they're going to make sure that you have to buy it. The exchange requires you buy it in LLC, and yet the lenders are going to say, well, gee, the money's much more expensive if you buy it in the LLC. So that, once again, is a conversation I'd like to have sooner rather than later, so you're not mad at me because I'm telling you got to buy it in the LLC at a later date. So that's where that issue gets to be so problematic, even for spouses in a non-community property state. Related party transactions. Now, related parties, you can do a related party exchange, but each party has to be doing an exchange, and each party needs to hold their respective replacement for no less than 2 years. Now, if you're selling a property to a related party and you're doing an exchange, that would be okay. They don't have to be doing an exchange into it. But if you're buying your replacement property from a related party, that's where this rule really comes into play. Now, a quick example, and it should be one of my examples at the end, but just an example of something that happened recently is a transaction where we're sort of, and we've got a number of, let's say families right now that have a portfolios of properties that are all jointly owned by the kids, but the kids are now in their 60s and 70s and they're wanting to do their own thing. Right. So now we're in a situation where maybe they're wanting to consolidate. Maybe they own 5, 6 properties and each one of them is going to take a couple of them. Right. So they want to buy each other out of these things or exchange each other's interest to make sure that one person owns this property, the next one owns this property, the next one owns this property. And the only way we can do the exchange into something when you're buying from that related party is that party also has to exchange. So we had a big multifamily project, and the one brother wanted to buy the other brother's interest out doing an exchange, and the other brother just wanted to take money and go put it in Wall Street. And when I started pushing, I said, well, gee, the only way you're going to be able to exchange into that his interest is if he does an exchange too. What's he going to do with the money? Well, I just said he's going to put it in Wall Street. Well, why? I mean, what kind of return is he being promised? So it's like, 3.5 to 6. It's like, well, is that 3.5 to 6 after losing 40% of his equity to tax, or is that factored in? How long is it going to take for this guy to be made whole, let alone to get to 3.5 to 6? So what I suggest in this situation is like he's going to have to sit there on his hands for, let's say, a year or two. But instead of him just selling, paying the tax, and putting the money in Wall Street, what we want to do is have each of you do an exchange. The brother is going to exchange into a Delaware statutory trust, but ultimately into what's called a 721 UPREIT, which means you're going to hold the DST interest, let's say, for a year or 2 years. Then his interest gets rolled into a real estate investment trust, and then he can sell those shares at will. And it's even better than that, because typically when you sell something, you're going to have to pay tax through the gain until you get to the basis. Well, 721, the taxation on 721, it flips it upside down. He says, so it sells through the base with no tax, and then you get into the gain. So if he does the exchange into that 721, it allows, one, the brother to exchange and buy his interest out, which makes him happy, but two, it keeps his equity intact. He's just got to wait a year or two until that thing rolls in the 721, and then he can take the money and go into the Wall Street stuff. So it was a situation where the exchange was not going to be able to be done, and the one brother is going to lose up to 40% to tax before he got to 3.5 to 6. And we change all that situation where both parties are getting what they want. It's just going to take a little bit of time. And that's, once again, a situation where you just don't know what you don't know, and you've got to start looking at it and understanding, hey, it's not just this deal. How do we get you where you want to go? All right. And related party transactions are problematic just from the holding periods. But once again, I'll just say on this slide, you can sell to a related party and do an exchange. You just can't buy from a related party unless both parties are doing exchanges and both parties are holding their respective replacements for no less than 2 years. So notes and seller finance, we talked about this a little bit earlier, all right? So notes and seller finance, a lot of times people say, well, you can't sell and do an exchange carrying seller finance. It's totally untrue. You can, but the note has to be ours at close. So I'll say that again, the note has to go to the accommodator just like any cash would. And what happens at that point is we could sell the note to a third party, which has just not happened for, I don't know, it's probably been, I have to ask my brother Tom the last time that happened. It's probably been 20 years since we sold to a third party. Just the discounts are often in excess of the tax consequence, but it could be sold to a third party. Second option is the note and cash could be used to acquire replacement property, which that has happened. Sometimes the notes could cross collateralized by the person's house or something because the seller replacement doesn't know anything about the property or know anything about that that note. But that is something that has been done. Three, the thing that typically happens is our client buys a note from us. You say, well, David, why would I buy my own note? What you're doing is substituting cash for the note. I've actually had people borrow money from the bank to buy the note. And you just sort of say, okay, what's that note paying you? And I had, last week I had a deal come in and the down payment, it was like $1.2 million deal. Down payment was 200,000. And the tax consequence was way beyond the two, and the seller didn't understand that they were going to have the tax hit on it was unencumbered, so they didn't have any debt relief, but they were going to have all the depreciation recapture. They owned the property since the 80s, so think of the depreciation recapture that was going to get hit. So in this situation, for this person to sell and have that note and not do an exchange, it was just going to be a brutal situation. But in this transaction, what could have happened is the note would come to us, the guy buys a note from us, and now the reason I brought that up, it was only paying him like 5% on it. I said, well, why would you carry paper and have your cost of capital is less than what a bank would charge? I mean, that's nuts. So, once again, it's yours. You better make sure it makes sense. But this guy, what can happen is a lot of times our client buys a note from us, and depending on what that note's paying, even the cost, even if you said the cost capital at the bank is 5 and the note's paying 8, you got 3 points there. That's not horrible. But what's going to happen with that thing, and what kind of, if you got money sitting in the bank, it's paying 8, and the money, and they're paying you 4. Well, gee, you just double your return having the money in that note. So, and it allows you to be totally tax deferred going forward. So that's why you'd buy your own note. 4, a lot of times you might have a situation today where the financing blows up at the 11th hour. You got to get the deal done, or maybe it's lender required repairs that require seller finance to get the deal done. In that situation, what'll happen is that note comes to us, the permanent financing comes in play, and then as soon as that comes in play, now we've got the cash to complete the transaction. So short term, meaning that note has to be paid off before we're going to buy what we're going to buy for you in the exchange, which means within 180 days, obviously. And I'd really like to see it paid off inside the 45, so you can sort of look and adjust what you're identifying to make sure that happens. And the fifth option is a partial transaction. So maybe you're doing, if the down payment's large enough, we do an exchange of the down payment, and then the installment sale treatment's going to be coming to you as it does over the life of the loan or whatever's happening with that paper. But here's 5 ways to handle a seller finance transaction in an exchange. With that said, I'm going to say get cashed out if you can. Though if it's an end game for you, talk to your tax people, understand the immediate tax repercussions and what you're really looking at over the life of it. Make sure that, once again, if it's an end game for you, you better have an acceleration provision, and you better have something talking about assumptions and preventing blind assumptions from happening. One of the things I like about note trust deeds over land sale contract, your lawyer's probably going to say, hey, a land sale contract's easier to foreclose because you're never relinquishing title. I like note trust deeds because we can always do an assignment of collateral. So let's say you sell and carry somebody, and that person's been a good borrower for you, and now they want to sell the property, and you don't want to have that acceleration on that note coming back to you. You could elect to do an assignment of collateral for that person, keep the note intact, and keep your income stream intact going forward with it. So that's just one of those little tidbits. I really like the note trust deeds better than the contracts for that specific purpose. Reverses. So in a delayed, we've been talking about this, biggest headaches time. A reverse, you got the same timelines. From the date of acquisition, you have 45 days to identify what you're relinquishing, 180 days to relinquish it, all right? And so we've got, with reverse exchanges or improvement exchanges, they're warehouse transactions, and we probably got about, I'm just looking at the clock. Of course, we're out of the hour, probably got about 10, 15 minutes left to get through this thing. So if you got to go, I understand. If you can stick around, you're going to get some good info. So in a reverse situation, we do it in two different flavors: warehouse relinquished and warehouse replacement. The reality is, as I said earlier in the presentation, the taxpayer can't own the new and old property at the same time. An improvement exchange occurs. We're going to buy a property, and really an improvement exchange is the same structure as a warehouse replacement reverse exchange, that we're going to create an entity to take ownership of that replacement property. If it's a reverse, we're just sitting on it. If it's an improvement exchange, we're building on it. But the same sort of structure. So when we're looking at reverse, we don't loan money. So if you've got the financial ability to get the deal done, we can do the deal. But if you don't have the money to get the deal done, then we're not going to loan money to make a transaction happen. So what'll happen is, if you got the financial ability to make this transaction happen, we're going to structure the exchange. If it's a warehouse replacement transaction, you're going to show up at escrow with the money required to buy the property. We're going to have a note saying we borrowed the money from you, and our entity is going to close and own that property until your relinquished property sells. When your relinquished property sells in the future, the proceeds are going to come in to us. We're going to pay back the debt we've got to you. If there's funds in excess of that debt, we're going to then, if there's a loan on that property, we're going to pay down the loan, then give you the new property. If there is not a loan on that property, we could build on the property, or you could buy additional property. So that's the benefit of a warehouse replacement reverse exchanges, that with excess funds, if you've got less money to put down than what you expect to net in a future sale, it allows us to make the purchase and pay down that debt at a future date. If we do a warehouse relinquished reverse exchange, you're still going to show up to purchase the money required. We're still going to have the note there between us and you for whatever the down payment is, but we're going to close on that replacement property, immediately transfer ownership to you. The same time we're transferring ownership of the new property to you, you are transferring the property or properties to be relinquished, and then the exchange is done. And when those properties sell, the proceeds once again are going to come back, repay the debt that we have to you, and the excess funds is either going to be taxable to you, or we could buy additional property. So buying additional property is going to come sort of in the form of a blended transaction. So we might have a situation where you're relinquishing multiple assets, or you've got more funds coming in, and so we'd have 180 days from the date of acquisition for you to sell what you don't want, and you technically would have 180 days from the date of that sale to either be done via maybe the initial transaction, finished it, or if you have funds in excess of what was initially loaned to us, then you'd have 180 from that relinquished property settlement date to complete the transaction going forward. And that allows, we can have a series of properties that are relinquished or received. You could have, let's say you're giving up 4 or 5 properties to buy one. Let's say you sold 3 before the acquisition happened. Those 3 came in via delayed exchange. The other 2 that had yet to sell, those are coming in the transaction via reverse exchange. Let's say on the other hand, you're sort of stretching things out into a series of transactions. We can take up to a year, if you think about it, by combining a delayed and a reverse exchange into one transaction. And that's what we call blended transactions. I guess if you wanted to get down and dirty with it, you could say a blended transaction is a reverse turning into improvement exchange, maybe too. But when we're talking in our company's context, that blended transaction is typically a combination of a reverse exchange and a delayed exchange, and that gets you clear out to that 1 year total exchange period time when we're looking at everything. So it's a great flexibility. It allows you to aggregate a number of properties or buy a number of properties through one transaction, and it stretches those timelines out. Improvement exchanges, as I said, really an improvement exchange is a warehouse replacement reverse. We're just going to take ownership of the thing and be doing what we need to do to that property, get the values up. So maybe you gave up $1 million property, and the property we bought via the reverse was only 800. So now we have a situation where we need to do a couple $100,000 in improvements to it during the time we're on it. That can be done. So in improvement exchange, we cannot give you a property and then have work done. The property has to be complete when we convey it to you. Now, let's say that you need to do a couple $100,000 worth of improvements to the property. I'll just say the first issue we've got to deal with. And remember that map that I showed you earlier with the states, and remember the gray states, and you look at states like Tennessee or Nevada or Florida or Texas. Well, these are states that typically like things to be built. I live in, I jokingly say, the People's Republic of Portland, or of Oregon, and here our governor says, oh, I need 38,000 houses built, blah blah blah, all this stuff, and yet they don't get it. All they got to do is get out of the way. All right, if they get out of the way, we can get the deals done. I cannot do an improvement exchange up and down the West Coast. Okay, and why I say that is, how long? Remember President Obama talked about shovel ready projects. Well, there's no such thing here. Okay, I mean, you buy a piece of property, and for the developers on this call, you know all too painfully how long it takes to get a shovel in the ground. I can't do a normal improvement exchange, because what happens in normal improvement exchange, we're going to go buy a property, somebody's got to go get the planning, engineering, permitting all done, and then when we get those all in place, we can then go vertical on it. Well, how long does it take to get a permit around here? I'm not going to get it in 180 days, let alone a year or sometimes 2 years. So I just can't do a normal traditional improvement exchange up and down the West Coast. If I do it in Texas, I can walk in and walk out with a permit, and boom, now we're going vertical and everybody's happy. So when we're looking at improvement exchange, the biggest issue is always going to be, are you ready to do it? If you've got access to property that's to be improved, maybe you haven't bought it yet. Maybe you can go out and work, and maybe the seller's able to work with you to allow you access to it, to go out and get the planning, engineering, permitting, all that stuff. So then when we have a sale or that purchase needs to happen, we can do those things. So let's say if you were ready to start the project before your relinquished property sold, well, that's a reverse improvement exchange. So you got to look at look at where we are, look at the timelines and when you want to do this construction. And, depending on whether you got access to funds, go sooner rather than later. Sometimes you need the exchange proceeds from the sale to go buy the dirt and do it. Well, that means the clock starts the day you relinquish the property. If you've got money and things available to get the project started before the sale, well, that makes it easier, because in that situation, we're just going to, go buy the property and get started on it when you're ready to do it. But we've only got 180 days to get the improvements done. Now, does a project have to be done in 180 days? The answer is no, but only what is done and constitutes like-kind real property, the 180th day qualifies. So you can't say, okay, gee, David, 180th days next week, and we got 200 grand left. I'm just going to go prepay labor and materials and call it good. Well, you can do that, but those things are not real property, so that's going to trigger tax exposure for you. So on the other hand, let's say you've got maybe the 1031 requires you got a $700,000 project, and the grand scope of the project's, let's say, $1.5 million. Well, as long as we get you $700,000 worth of improved property, the value of the dirt and the improvements is 700, we're just going to convey the project back to you. At that point, you finish it at your leisure. So, what we're looking at is what is considered like kind at the date we transfer those properties. And it's not all or nothing, and the project doesn't have to be done, but only what is done within the exchange period is going to constitute like kind real property and qualify towards the exchange. Obviously, the last few slides, these are things I always want you to give a call. Remember at the very beginning, I said, give us a call. Give us a call. Go over this stuff. Let's plan it out in advance, and that way you're going to be going the right direction. We can try to fix things later, but it's so much better to understand, figure out that roadmap early on, and then follow that plan getting through it. You're going to be a lot happier in that situation, because things happen. So anyway, a lot of improvements being done. So give us a call, and happy to talk to you about it. Combination of personal plan money. So, like I said yesterday I was scheduled to do an IRA presentation. I'm watching Wall Street, and it just was sort of not entertaining, sort of frustrating. I'm not a Wall Street guy. I feel like it's a big casino, but I've got money in there. We should all have diversified portfolios of investments, and sometimes it's painful. Sometimes it's really a good thing too. But anyway, we've got a lot of people that want to combine personal money and plan money into common investments. And you can do that. You can do it either via a tenancy in common, or you can do it via common membership of an LLC, and each of those structures has its benefits or pitfalls. The tenancy in common structure is going to be necessary if you want to do an exchange into a property and use some IRA 401k funds in addition to your 1031 to go buy a property. And that TIC structure is required not because of the IRA 401k, it's required because 1031 once again prohibits partnership interests. So we would exchange into the tenancy in common, and you would be technically a TIC owner of that replacement property along with your retirement account. And that's something that it's very easy to accomplish. If there's lending involved, it's got to be non-recourse debt, but it's something that's done, and it's not that uncommon to do. The other way to jointly own property is to use a limited liability company, and that would once again prohibit 1031 funds from going in, but it's a nice way to do stuff. And a lot of times people's end game with IRA 401k owned assets is to personally own those properties. So sometimes if we're talking about IRA 401k class right now, we'd sort of be talking about required minimum distributions, RMDs, or how do you actually end up owning a property that's owned by your IRA 401k, and that's through a series of in-kind distributions. And so basically you're taking distributions of a TIC interest or a membership interest in the LLC that slowly conveys ownership from the retirement account to you. I like the LLC structure there because you're not changing deeds every time you're changing ownership. You're doing assignments of membership interest, and that conveys the property from the retirement account to you until a point where you own the entire entity that owns the asset. So those assignments are a wonderful way to do stuff. The other thing that's nice is something that with in-kind distributions, minority interests, it might even be possible to discount those in-kind distributions if it's a minority interest by up to 40%. Once again, another class, but something that's possible. A few examples, we're done. Okay, so this is just a situation where, once again, it's not all or nothing. And understanding your tax liability on this, these people gave up a $3 million multifamily property, and all they wanted was $1 million place in the desert, all right? So they had tax exposure on the difference between the 3 and the 1. $2 million in boot, that's a big chunk, right? So make sure you got the money to pay the tax obligation, or make sure you've got some way to mitigate some of that tax consequence, maybe with losses offsetting gains, so on and so forth. But they ended up buying that $1 million property and said, well, gee, David, they went down value $2 million. How much gain did they have? Well, their basis was $250,000. So they deferred the gain on the difference between the 250 and $1 million. So they deferred gain on 750, saved them $250,000 in tax, and they had the exposure on the difference between the $1 million and the $3 million. And once again, that's what they wanted. Get them what they want and give them those options, and that's what was going to satisfy these people in this transaction. This is just an example of taking and leveraging into different things, and once again, understanding what you're buying. And you think about, I mentioned that Clarkowski court case earlier with determining dealer status. And so in a situation like this, people exchange out of a vacation property in that just a single property, and they went into a tenancy in common in a multifamily project, and they bought 3 other properties that were single family rentals. That the game plan with those was to do fixers on those things, but without having to become dealers. So, anybody that's flipping properties, not only, like I said earlier, does not qualify for 1031, but you're looking at normal income tax. So anyone that's done a couple of those, you're going to get real tired of losing, half what you made to tax. So by doing the improvements and doing cash out refi after you've gotten renters in there, getting them stabilized, holding them for a couple of years, you're in a situation where the refi money's not taxable to you. You've then rented out for a few years, and then that justifies another exchange. So that was the MO for this group, and it works very well. And so once again, in today's world, you look at like the bigger pockets, they just love that BRRRR acronym like it's something new. It's been around for 50 years. It's just we didn't have an acronym for it. So this is something where you're taking it a step further. Instead of just buying, fix and refi and repeat, what you're doing, you're renting the thing out, seasoning it for a period of time, and you're ultimately at some point your equity increases to a level, the ROI gets dropped to a point where it no longer makes sense. And how do you decide? You've got two options: do a cash out refi, or you get rid of the property, do an exchange. How do you decide between the refi and the exchange? Well, is there anything you can do that building that is going to further increase the value? And if you look at a typical hold for like institutional investments, maybe it's 5-7 years because they want to build the thing out, build it out, fill it up, and then they want to turn it before they start having to put money back into the project. So yeah, you just got a period of time there where you're going to realize your ultimate ROI, and there's really, there's an argument, why would you ever sell a great piece of property? And I get that, but there's a lot of times where you're just going to end up having to put more money back into it over a period of time, and the increase in value is not really there anymore. So you've got to decide at some point, is the refi the right choice to keep it, or is it exchanging out of it? And the 1031 obviously is the vehicle to keep your money yours and working forward. Third example, this is a situation where we talked about phantom gains. So in these transactions, what would happen is, and sometimes we'd have these institutional people that are coming in, and they're working with the group of investors to save the asset. In the 11th hour, they say, well, you know what, you're not savable. We're going to take the property. So we would get a call that we'd have up to 25 different investors with this transaction, and they've got a pretty simple math equation to figure out. It's like, okay, gee, they're going to take the property. Do I want to do an exchange, or do I want to pay tax on phantom gain? The destination in this time, at that point in time, and these are deals we were doing over and over again, unfortunately, was something called a zero coupon DST offering. The Delaware Statutory Trust had, it's non-recourse debt, and a zero coupon might be 80% loan to value. And so the question to the taxpayer was, look, if you lose the property foreclosure, you can pay up to 40% in tax, or you can effectively look at a DST, a zero coupon offering, as a 20% tax. So it's like, okay, you pay 40, get nothing, or you come out of pocket 20%, half of it, and you're going to get something. You might not get a check in the mail because those zero coupon offerings don't pay you monthly, but then over the life of that investment, maybe 7 years, you're going to walk away at that point with equity build up. And like I said, it's a pretty easy choice to make. One, you're paying twice as much and getting nothing. The other is you're paying half as much and getting something. So, and I remember having conversations with people, I can't afford the 20%. What, can you afford the 40%? So it's something that, fortunately, we have not seen rear its head again. But if the finance market doesn't change and people are getting stuck in properties, this is just something to keep in mind, that just because you lost a property and you didn't get any net equity out of the thing doesn't mean you have any tax exposure. So make sure you're talking to your tax people, understand the tax liability you're potentially staring at, and then you can make the right decision. And what happens is, like I said, the transfer of ownership is happening before the foreclosure occurs. That transfer starts at 45,180. Fourth example, it's just an example of a large home, large gain. These people had $3 million gain, $1 million in taxes. They got referred into us by their legal counsel. Actually, it wasn't their tax counsel. He was the husband was a lawyer, wife was a CPA. She knew what the tax it was. She didn't want to deal with it. She also took control of this transaction. So what happened? We told them to move out of the house, season as investment, which they did. A year or so later, they'd already bought their new home. So a year or so later, they then sold the home, bought 24 different replacement properties, closed them all inside the 45 days, because she didn't want to deal with that 200% rule was not going to work with the 24 properties they bought, and the 95% rule, she didn't want to deal with the potential of a sale fail. So we went from $1 million tax hit to zero tax, and got them 24 different investment properties inside the 45 days, and that was a great transaction. Last example has nothing to do with 1031. It's a teaser to get you to go, listen to an IRA 401k class. It's your money, right? IRA and 401k funds are yours. If you've got IRA or 401k funds that don't allow you to buy real estate today, If it's IRA money, it's based upon the custodian that you're working with. If it's a 401k, it's based upon the trustee administrator, or the plan document is going to restrict what you can and can't do. So creating these things is not hard. If it's a current employer 401k plan, we might have some issues there, because if you're under 59 and a half, you're not going to get access to the money. If it's a current employer 401k plan, previous employer 401k plans, you have the ability to self-direct. Any IRA can be self-directed. But this example, what happened is people, they came into us. His and her IRAs retired. They wanted to combine those two IRA accounts, go buy a mobile home RV park, which typically we'd use something called a checkbook IRA, IRA LLC, which means that we would create custodial accounts for each IRA. We'd create an IRA-specific limited liability company. Each of those IRAs we're making investments in. Then that LLC would buy the park, and that would have satisfied their needs as far as if it was just a pure investment. Well, as we started getting into it, we found that they wanted to not only be the on-site managers, they wanted to take compensation, they wanted to be the on-site managers living there. Both of those things constitute prohibited transactions in the IRA 401k space. So we had to shift gears from that checkbook IRA, IRA LLC to something called a rollover business startup, which is a combination of a 401k plan and a C Corp. So we moved his and her IRAs into the 401k plan. The 401k plan bought the C Corp. The C Corp bought the park. These people got an investment, they got a job, and they got a place to live, all with that transaction. And that's an extreme example of what is possible with retirement accounts. I want to thank you so much for joining us today. I would encourage you to take a look at our different resources when you've got questions. That YouTube channel is very robust. There's hundreds of videos up there on everything from the aforementioned cost segregation to even selling life insurance contracts, charitable remainder trusts, a variety of things that even qualified opportunity zones. These things don't have anything to do with 1031. They're just things that we feel are of value to you, the investor, or if you're a broker working on things, I think it's valuable to understand where people can go in these transactions. So don't hesitate to reach out with questions, but take a look at those things. We also have podcasts, so if you're taking a trip someplace, you want to learn some more on some topic, you can take a look at the podcast. And then finally, we've just got IRAadvantage.com for the retirement accounts. Post 1031 is a property listing site. If you're a broker trying to get property into front of people, our people, that's typically where we're sending them. There's both free and paid postings up there. And then 1031exchange.com is Equity Advantage. I thank you so much for joining me today. My name once again is David Moore, and this is Equity Advantage. And I really look forward to speaking with you soon. And once again, if you need credit, reach out to Seymour at 1031exchange.com. We will be sending the slide deck out too. And I hope you got a lot out of it today. And I look forward to working with you soon. Thank you. All my best. David Moore signing off. Bye-bye.